Most homeowners pay their mortgage with what's left over after the government takes its cut. Using post-tax income to service a non-deductible debt is the most expensive way to own a home, as every dollar of interest costs you nearly double in gross earnings. Debt recycling is a structural maneuver used by mortgage brokers to change the tax status of that debt without requiring a pay rise or a lifestyle change. The strategy works by converting personal debt, which offers no tax relief, into investment debt, where the interest costs can be claimed as a deduction. To execute this, you need three specific components: established equity in your home, an active offset or redraw facility, and an income-producing asset. By reconfiguring your loan accounts, you ensure that the interest you are already going to pay starts generating a tax refund. Step 1 is identifying your usable equity. This is the specific portion of your home's value that the bank allows you to access for investment purposes. Lenders generally cap your total debt at 80%. If you mix personal spending with investment debt, the ATO considers the account contaminated. If you skip this split and simply redraw funds from your main mortgage, the tax-deductible status is voided because the purpose of the debt cannot be cleanly tracked. The two-account structure provides the clear audit trail necessary to satisfy the legal requirements for a deduction. Step 3 is the pay down and redraw. This is the mechanical moment where the tax status of your money actually changes. You move $100,000 of savings into the investment split, bringing its balance to zero, effectively closing the old debt. When you instantly redraw that $100,000, the loan is reborn. Headed for an investment, the interest on this $100,000 is now deductible. Step 4 is deployment. Redrawn cash must not touch personal savings or daily accounts. Funds must move directly from the loan into an income-producing asset, like an ETF. This direct path proves the purpose test to the ATO. By maintaining this isolated flow, the interest costs on the $100,000 split become a legitimate tax deduction against your salary. Step 5 is the audit trail. The strategy is only as good as the bank statements that prove it happened. This statement shows exactly what your accountant needs: a clear record of the redraw occurring, followed immediately by the outbound purchase of your investment. Save these documents into a dedicated folder. They are the primary evidence required to justify the deduction on your next tax return. With these records, your accountant can confidently claim the interest expense, reducing your taxable income for the year. To see why this matters, we have to look at the annual cash flow. You haven't increased your debt. You've just changed how the tax office views it. At 6%, a 100K split generates $6,000 in interest. In a 37% tax bracket, that creates a $2,220 annual tax refund. Funneling that refund into your primary mortgage accelerates interest savings. Over 15 years, annual refunds and reduced interest result in an $88,000 net benefit. Use this checklist with your mortgage broker. Ask to split the loan, define your investment amount, and confirm your redraw is active. Most major retail banks rarely suggest this kind of structure to customers because it directly reduces the total interest you pay them. It is up to you to implement the setup and reduce your structural interest costs.